This builds conviction, folks. This is what gets you to scale your performance up because you're building that systemic recall and cognition to go, I recognize this pattern and I am willing to commit to it. Hey, fellow trader, it's good to have you back. Mike here, reporting again from Axia London HQ, here to bring you part 2 of the Market Profile for Beginners series. Now, if you haven't taken the time to watch part 1, I highly recommend that you click that link above to ensure that you're on the right track to follow along with today's video. All right, let's get into it. Today, I've got 3 objectives for you. First, we're going to talk about what exactly it means to recall a pattern within the context of market profile. Then, we're going to talk about what it means to engineer patterns that are not just from the classical view that the likes of Jim Dalton bring us with the market auction theory, but patterns that you actually engineer from your own holistic creative mind. We'll touch on some of the patterns that I've created, that other Axia members have created, and I'll show you also an efficient way to log those patterns in something like Notion, in something like Evernote, for your future self. Now, what do I mean by that? I just want to remind you all, most of you are probably not only in this business for the short term, but you're looking to create a career long term. So it is critical that you log these patterns that you witness on the day-to-day trading sessions for your future self. Because who knows, that special pattern, that life-changing pattern might appear in a year's time or maybe even 10 years' time. Lastly, I'm going to show you how to unlock the power of pattern bridging, not just using the market profile, but using the market profile alongside the footprint and then even alongside the price ladder. This is a critical skill to have and develop to be one of the top traders in this business. Now, what I've got for you here is some recall of some classic Jim Dalton style market auction theory patterns. Now, I want to just cover these patterns in case you didn't catch that first video and in case you've never looked at a market profile before, to give you context of what these patterns tell you and what they help you ascertain about the market's communication into those following sessions. So I've got 3 main patterns for you that I want to highlight. Number 1 is this yellow box here that you can see says balanced short-term trading. Now, when you have a market that is creating an even distribution of value with a relatively weak tail to the downside and a relatively absent tail to the upside, this defines short-term traders keeping a range because clearly nobody wants to shift value lower or higher. The following day, we have what we would call a B-shape short side liquidation, meaning that the structure itself is showing a large node, right? And when I say B-shape, I'm talking about the letter B in lowercase, right? Lowercase. So you can see as I trace it out, it starts to look like the letter B in a lowercase. Now, why do we call it the B-shape? Well, the short side liquidation means that a lot of traders here are trying to sell the market lower, particularly because of this failed attempt through a new low. And keep in mind, the market did manage to break a new low from that previous day where we had balance. So there's a lot of accumulated selling here, right? And we'll just clean it up again. So as you can see, at some point within this day, there is a double distribution, a double single print that develops where a liquidation of all of this liquidity leads to prices appreciating, thus showing us the short side has liquidated, right? And that right there is your short side liquidation B. Now, we can get even more information from this B shape by looking at the fact that the volume level compared to the first value distribution is much lower. Now, that's actually why we don't call this a double distribution, because if the value that developed up here was nearly as great as what you see down at the bottom here, then you would have a double distribution. But in fact, this is just a B-side liquidation with still no real conviction to put in a tail on the upside or the downside. Now, the following pattern coming out of those 2 days starts to get interesting. We do start to see some double distribution of value. Keep in mind that the higher value node was actually greater in volume than the lower value node, but shorter in range, right? So sometimes these double distribution patterns can look a bit different, but judging on what you see the days prior, here and here, you get an idea as to why you might be seeing that shape. So consider the fact that the low value here didn't really get anything for its buck, right? At its second attempt the following day, it's pretty clear that whatever value is here is trying to get business done within that area, and swiftly the market moves lower. And what I mean is you can see it's not quite a double or a single print, but it's about a triple or quadruple print here. It's not like what you saw those 2 days prior where any move down is that constant, distribution with no real conviction to appreciate or depreciate the price or the value. Once you start to see the market come back into that value where originally a lot of short side was developing, there's not a lot of conviction to stay here as long as you did the previous day. You end up seeing a swift move lower, which breaks the previous day low and the previous day low, thus implying that short-term sell side is in control, giving you that double distribution to what you could call a marginal trend day. The last pattern is important because this is NFP day. Again, this was literally just the other week, March 7th, Friday, coming into the February report of 2025. So this trend continuation is a little bit more important to consider in your logging because it's driven by a data point, right? It's driven by an expected scheduled market volatility trigger. The big notice I have when I explain the previous patterns is, again, that value at the 2180, 2170 level, although it managed to print a decent amount of distribution and put in a decent tail, that move down that you see was quite swift through the value that we see here and through the value that we see here, where the market essentially liquidated, giving you a single print continuation and then a low value distribution in a new multi-week low that essentially you could call a trend continuation that breaks a multi-day positioning, right? Now we have a lot of information on how the market is behaving and how it is trying to price the development of value. And that's the key bit from that classical auction theory, folks. Now, I want to cover a more holistic approach that you can take using those classical patterns, but then getting more refined in how you log them. So what you're going to notice here is I've got these little white circles, and what these are identifying is a one-time framing, right? So we have 1, 2, 3, 4 days, as you can see here, of one-time framing. For those that don't know, in market auction theory, one-time framing is when the previous day low is not tested. So you've got 4 days of that low not being tested, with the 5th day giving the first break and the first clue that we might see a liquidation of this upside positioning soon. This also applies if you have the high not being tested and the market is trending lower. Now, when you see value starting to develop, especially with a lack of a tail, you can then start to engineer a name for that, a brand for that, right? So just to be specific, I'm going to bring over, and we're going to get rid of this for a moment. I'm going to bring over my Notion template. so that you can see how you can track this efficiently, like I said, for your future self. So, for example, this is the market we're currently looking at the ES, as you can see, specifically the H contract for March of 25. The roll is soon. And we're looking at the orange print. Now, if you want to know more about why we color our TPOs and our market profiles, that's something that you can learn in our career programs and our available courses on our webpage if you are curious. But in short, it's to be able to identify a time period of the day visually. Coloring your ladders, as you've seen I've done on the TT tutorial, coloring your TPOs is just as important, because when I see, for example, the orange print, I know that means it's 6 p.m. UK or lunchtime US, about 12 or 1 US. So when I go and I log a pattern, I can see, okay, it's the purple print, which means post open drive cash, right? It brings greater context and greater cognition and response time to your craft. The market vicinity, well, think back to those classical auction patterns, right? You can see I've marked buy imbalance high, right? We talked about imbalances in video 1. Well, it's pretty fair to say that after this trend-like profile develops a low value buy imbalance, right? Because buyers imbalance what was once a balanced market, right? 1, 2, 3, 4 days of balance. That imbalance leads to 1, 2, 3, 4, 5 days of continuous buying imbalance, which is then found to be broken on this low value distribution to the downside, where we did get that first break on the days prior. So again, just to be clear, we are ensuring that when future self reviews these patterns, you are able to quickly and efficiently recall what you're looking at and what it means to you. So we have a buy and balance high. As you can see, there's that buy and balance. We have a single print, which develops on the actual trend continuation break here. And we also have what I would deem as the potential pattern defined. So the vicinity, I've named it the market vicinity and not a market pattern, because it's giving me a understanding of the imbalances and nothing more. The potential pattern is the holistic part that I've come up with myself. So the one time frame we understand from the classical auction theory, but now I have a pattern where I look for a one time frame break, right? Does that occur? It does indeed. The one time frame breaks here, and it gives me even more. It gives me the fat bottom, lack of tail. So often when a market develops value, it doesn't always develop a tail. Now, the value that's developed here, it did not manage to put in any kind of buying tail, any kind of extreme. To the upside, it didn't either, actually. But because we've broken that one time framing and given a clue that the market might want to head back to previous week's value, you can start to consider that a one time frame break might be validated in the coming session, especially if there's data around the corner or lingering unscheduled news, like perhaps a Trump comment or a Trump post. You can see here I've got multi-day positioning attack, meaning the break of trend here is attacking this multi-chunk value, right? Showing an invalidation of that value, as you can see here, multi-day positioning attack. And lastly, we have that's all the patterns here on this one, to give you kind of the next step of pattern layering and pattern recalling. So as you can see here, deep immersion with intentional pattern logging builds new patterns that will reemerge again. So I really want to emphasize this, that deep immersion requires you to do this on the weekend. it's going to be very difficult to be able to catch and merge these patterns into something that you can actually use for your future self and your future execution if you don't do it when the market is closed, and you can really immerse yourself in that process. Now, I just want to move on to the next slide to show you another set of classical patterns that are mixed with some patterns that I've layered for my own logs. So let me just pull up that Notion again. So in this case, we've got CL April 25, so the current contract. The print in focus is the blueprint, which is the post-EU Open Drive cache. And we have a market vicinity of a sell imbalance low. So let's just take a minute and cover what we're looking at there. So again, I said we have a blueprint, which is the post Open Drive cache of the EU session. So as you can see, when you look at all of these prints, anytime you see blue there, that is defining the European session, right? So it's very helpful because I can say, aha, there was some buying that established in the European session that the purple, right, the post US cache tried to attack but failed. Thus, the following day, those European buyers got what they were looking for with more buying from Europe, and then incidentally, US cash ended up buying at much higher highs than where they were selling on the previous day, right? So it's important to mark where and who is participating. Sorry, who is participating and where. So branding is the next part here. Branding is critical here. So yes, you've got the classical brands like the one time framing from the market auction theory that Jim Dalton gave us. But what about things like weak top machine gun slicer? What does that mean? Well, anybody who's taken the Axia price ladder course knows about the machine gun slicer order flow pattern that we use on our price ladders. So what I did is I bridged, right? Pattern bridging. I bridged what that auction pattern usually looks like, right? When I say go to my loom and I pull up some of these videos that I have of my execution within the market session, and I bridge that with where we were in the vicinity of the market and how the market ended up getting through that weak top, right? So we talked about a lack of tail on a profile. This here is a lack of a tail, right? This is a completely balanced profile. So I need to look for a machine gun slicing order flow pattern to actually take this tail out. And when you open up the footprint within this pattern here the following day, you can bridge the footprint design with the price ladder machine gun slicer and the fact that there's a weak top on the market profile, right? So this is really the meat and potatoes of pattern bridging, folks. Again, we've got the oil, we've got the vicinity, we've got the sell imbalance low from that classical theory, again, meaning we've got 4 days of downside time framing, lower low, lower low, lower low. Then we get a balanced day with no real tail to the upside or the downside. And then boom, you get a 2-day firm and stern, which again is another pattern, meaning that there's firm buying, stern meaning refusal of the new low, and then a multi-day position break and machine gun slice through the weak top. Seeing this 2 times, 3 times, 6 times, 10 times, this builds conviction, folks. This is what gets you to scale your performance up, because you're building that systemic recall and cognition to go, I recognize this pattern and I am willing to commit to it, right? This builds the elasticity by recalling patterns you engineer. It's much easier to recall patterns that you engineer versus the ones that you find in the textbooks. And that's the key bit here, folks. Great. Now, I've showed you a little bit of the footprint in terms of, well, I actually haven't showed you the footprint. So I've showed you a little bit of my template here. So before I go into the final pattern, I just want to show you some of those footprint designs here within my Notion that correlate to the oil that I just showed you. So this is kind of a quick lesson on how to be efficient with your logging. So I've got a table or a column for the contract, a column for the print, a column for the vicinity relative to what Jim Dalton's theory says. And then we've just covered some of those defined potential patterns. Obviously, you're going to have a place to put the screenshot. So you're seeing them in my slides. But for example, if I go ahead and click that, you're going to see the same exact pattern I just showed you, but just neatly logged for quick retrieval later. And then lastly, you can see I do the same for the footprint, right? So you can see I've got a nice footprint design that correlates to what I'm seeing on the market profile. So again, folks, if you want to learn to log these patterns efficiently, you want to learn how to understand and identify a footprint design that correlates to your market profile, sign up for those courses. Go and learn and see an accumulative years of experience from traders here at Axia on how you can create conviction using this pattern bridging tactic, folks. So with that said, I'm going to close with one more pattern for you that I particularly found interesting from this week's NFP with the footprint included. So you've got the Russell here, which if you're watching the market lately was definitely the outlier in Friday's session, given the range. Now, there's a lot of market profile patterns that I've learned here at Axia. One of my favorites being the bikini bottom profile. Now, this is always a fun name because you can recognize it quickly, right? So if you look at this pattern here, that right there indeed looks like a bikini bottom, right? So more importantly, when I go to that log and I look at the Russell, right? And I look at the specific print that we're looking at, and I understand where we are relative to the vicinity, I can then go and click and say, aha, we've identified a bikini bottom, right? These are already logged and ready for me. And also, I include a reminder that just says that this is driven by a rapid data imbalance, right? A NFP market liquidation. So to close this video, folks, I'm going to show you a quick pattern bridging between this bikini bottom profile and some clues on the footprint design that are not even on the Russell, but are actually on the ES. Because remember, our matrix correlation is also a key driver here in that conviction. So buyers respond with little conviction pre-NFP uncertainty, i.e. fat bottom, lack of tail, right? It's not a great fat bottom, but there's definitely a lack of a tail, and there's definitely order flow pace that is reminiscent of fat bottom type trading. The following day, you get the pink print whip. Now, for those that have been watching my streams for a while, you might have heard of the white print whip, but we've changed the color of that data print to pink. So as you can see here, I have this available as well. Pink print whip. So just from a holistic standpoint, what does that mean? Well, it means that when data hits every day, usually at 8:30 US Eastern or 1:30 UK PM, usually you get a liquidation move, and sometimes, more often than not, it's a single print. So why is that important? Well, when I look at this structure, it's not just a monocolor profile. It literally tells me, aha, there was a data set here that caused this imbalanced extreme, right? We're building cognition. We're building recall. We're building that elasticity to be able to be convicted in your structures, right? So that bikini bottom starts to develop once the range gets extreme and we get the break of an inside week plus a multi-week, even multi-month. And you get that bikini bottom validation, which you know the characteristics that you can then apply to your order flow review of high volatility, data-driven, a multi-week level break. And then that leads you into some footprint patterns that give you even more to add on. So if you guys look closely here, I've put these circles here to identify the lack of selling that is, sorry, the lack of buying that is occurring at the bottom of these tails. Now, these 3 circles here, I know it's hard to see, but if you look at the offers lifted on the right and the bids hit on the left, essentially there was no offers left to lift on the right side of the profile of the footprint, meaning that there was literally 0 buyers willing to lift at the price that the sellers were selling the market at, and that is reflected within the bottom of those 30-minute bars on the ES. Not the Russell, but the ES. Amazing stuff, folks. I hope this video was helpful for you, and I look forward to the next one.